It's time for Charting Futures, where we dive into the futures markets through the charts. And today we're returning to the question of whether a major stock market sell-off could be ahead with our friend Dennis Gartman, who is the editor of the Gartman Letter. And Dennis, thanks so much for taking the time to join us. And the last time we chatted, we talked about your call for the possibility of a major stock market sell-off. And since then, you have published what you are calling the most important chart of the year. So allow me to share this with our viewers first. And you can see this in the Bloomberg using the GTV function. And what we're looking at here is a long-term chart. On bottom, we have the S&P 500 right now near those all-time highs. On top, we have the S&P 500 dividend yield in white and the two-year yield in blue. And you can see that for the most part, there's a pretty decent space between them, with bonds yielding more than the S&P 500's dividend yield. But we last saw a cross back in 2004 and then 2008. Of course, that was around a time of tremendous market volatility. And Dennis, the point you're making is that right now we do have the two-year yield going back above that dividend yield. Perhaps there is a regime shift. So can you give us some more context? And does this mean that the end of the big bull market is over?
I think that it really does mean that the end of the big bull market is over, as that cross occurred back in late 2008 in anticipation of the bull market that began. And I think that that was one of the reasons. Over the course of the past several years, you've heard people say, Tina, there is no alternative. People had to turn to stocks. Now, however, the two-year yield has gone above the dividend yield on the S&P 500. Now there is an alternative, and I think that that's one of the primary reasons why we have entered what I think is a primary bear market. Listening to Lacey Hunt just a few minutes ago talking about the decline of the monetary base, which is one of the few aggregates that I really pay attention to, is exactly the same reason that I'm concerned about the stock market. From 2008 until basically last September and October, the adjusted monetary base was increasing. Now the Fed is allowing those securities to roll off. It is no longer sponsoring declining interest rates. It is now sponsoring rising interest rates. And I think that's going to give rise to lower stock prices over the long term. So I may be bullish in the short term for a couple of days just because we got terribly oversold. But strength is to be sold into, weakness is not to be bought.
So a repricing of risk ahead. Well, the last time we talked, your trade was actually to short the S&P 500 E-mini futures. Would you be doing that for the medium term or long term?
Right now, I'm on the sidelines. As I've said in my newsletter, in a bear market, there are three positions you can have: very short, modestly short, or neutral. Right now, I am neutral. But if we start to get a little bit higher, if we start to take stock prices in the Dow maybe 200 points higher from here, if we start to take the S&P maybe another 5 big figures higher than where we are right now, if we take the NASDAQ up another 10 or 15 points, at that point, and it'll depend on a number of other technical circumstances, but almost certainly I'll begin selling the market short one more time.
Yeah, it can certainly be tough when you're in the middle of a sideways trend. And very quickly, Dennis, nickel popping higher, soaring on the day. It's best day since 2009, the possibility of sanctions against Russia. What do you think, and what is the trade there?
I think nickel is exemplary of what's going on in the commodity markets generally. People are not paying attention to the fact that there is inflation taking place in commodity markets around the world. Corn prices are stronger, wheat prices are stronger, cotton prices are stronger, lumber stronger, sugar stronger, and the base metals are stronger. That is indicative of stronger economic activity. And what I actually do think is, with the monetary authorities reducing the supply reserves in the system, while the economies of the world are getting stronger, money has to come out of the capital markets, and it's going into it's coming out of the equities market and going into plant, equipment, and labor. That's going to be another fundamental reason why the stock market, I think, is overbought and likely to head over the next 6 months, a year, 2 years, rather markedly lower.
That's an interesting point. Another piece of a possible regime shift. Dennis Gartman, thank you for joining Charting Futures.